Ever had a customer who looked reliable, placed a big order, and then never paid? One bad decision in your credit process can wipe out months of profit. Your credit department is the first line of defense. And today, I'll show you how to build a bulletproof system to protect your business. Welcome to Accounting Best Practices UK, where we break down accounting and internal controls into simple, practical lessons for bookkeepers, accountants, and small business owners. Today, we're diving into the credit department, often overlooked but absolutely critical for protecting your cash flow and avoiding bad debt. The credit department isn't just pushing paper. It decides which customers are safe to extend credit to and how much they can buy on account, and on what terms. Done right, it fuels business growth by allowing the right customers to buy more. Done wrong, it creates unpaid invoices, cash flow gaps, and debts you may never recover. Imagine this: you approve £20,000 of credit to a new customer with no checks. They default, and suddenly you've lost the equivalent of hundreds of sales. That's why your credit department isn't just administrative, it's a risk management function. Before granting credit, always carry out a proper check. In the UK, that means using services like CreditSafe, Experian Commercial, or Company Check for limited companies. For sole traders, you can use TransUnion or Equifax. And don't just check once. Look at things like payment histories, county court judgments, or frequent director changes. These are red flags. A common mistake small businesses make is relying on gut feeling. I've met the owner, they seem trustworthy. But trust won't pay your invoices. Data will. Next, standardize the process. Every new customer should complete a credit application form. This isn't just bureaucracy. It captures legally important details like company registration number, directors' names, trade references, and banking information. It also protects you with anti-money laundering compliance. If HMRC or your auditor asks, you can show a paper trail that proves you didn't grant credit blindly. Every customer should have a set credit limit. This could be £500 for a new client or £50,000 for a long-standing partner. The key is to enforce it. Use your accounting software to block or flag orders that exceed the customer's limit. If you don't, sales staff under pressure to hit targets might push through risky orders. And once the goods are shipped, it's too late. You're left chasing payment. Credit limits keep enthusiasm in check and ensure risk is balanced with reward. No one should be able to approve credit alone. Build in a workflow. For example, requests under £5,000 can be approved by a finance manager. Anything above that requires sign-off from the finance director or CFO. Why? Because spreading responsibility prevents reckless decisions. It also creates a log of who approved what, when. That record is invaluable if a decision goes wrong later on. Finally, credit isn't set and forget. A customer that was low risk last year might be in financial trouble today. At minimum, schedule an annual review of all credit accounts. For high-risk customers or those who have started paying late, review sooner. In practice, this means checking their payment patterns in your ledger, looking for overdue invoices, and rerunning a credit check. Many UK firms discovered this the hard way during COVID. Customers who were reliable for years suddenly became high risk overnight. Regular reviews protect you from nasty surprises. Even the best policies fail if staff can override them freely. Limit who can override credit limits and require dual authorization for any exceptions. For example, if a sales manager wants to extend extra credit to secure a deal, require approval from finance as well. In systems like Sage 50 or Xero, you can configure user permissions so unauthorized staff can't just change credit limits in the background. Remember, controls aren't about slowing down sales. They're about preventing one risky decision from damaging the whole business. Keep everything documented. Applications, credit reports, overrides, memos. Attach them to the customer's account. Why? Because when auditors or HMRC review your books, they want evidence of your process. And if you ever have to take legal action to recover debt, those documents prove you acted responsibly and in line with good practice. No paperwork, no protection. Strong credit controls are the foundation of a healthy accounts receivable process. Without them, you're inviting risk and relying on luck. With them, you're protecting your cash flow and your future. Next time, we'll cover billing and collection controls, how to make sure your invoices are paid faster and disputes don't drag on. If this video helped, hit like, subscribe, and comment below. What's your biggest challenge when it comes to managing customer credit?